Good evening, ladies and gentlemen. Thank you very much, Ruchira and Moneycontrol, for calling me here and giving me this opportunity. I'm going to start with a couple of caveats and a little plug about SEBI before I move on to the topic of the day, which is mutual funds. First of all, within SEBI, I don't look after mutual funds. It's my colleague, whole-time member, Amarjeet Singh, who does so. So if you have some good things to say about SEBI, I will take it here. If you have anything bad, I will pass it on to Amarjeet Singh. And the second thing is, I have to give you a warning. For about 4.5, 5 years, as Ruchira mentioned, I taught at an institute, and the students there had the misfortune of having to listen to me. From my teaching experience, once I get the mic, I don't let go of it. So expect to be here for a while, and the sight of people sleeping does not deter me. Now, a very quick plug about SEBI. Look, something that we remind ourselves every day within SEBI is that the SEBI preamble, the SEBI Act 1992 preamble, talks about 3 pillars which form the mandate of SEBI, right? They are investor protection, market development, and market regulation. So you often think of SEBI as a regulator, which is true, but only partially true. If you put these 3 mandates together, our actual mandate is aiding capital formation. It is sustained and sustainable capital formation that forms the cornerstone of our existence. So it's not just our job to regulate. It's not just our job to say no. It's not just our job to stop bad things from happening. It's also our job to facilitate good things to happen. Okay? So if you have a impression, or if you get the feedback that actually we are doing only one part of the job, do let us know, because then we are not doing our job appropriately. Now let's talk about mutual funds a little bit, and I'm going to break this up into parts. There's a first part which is a celebratory part, because I do think mutual funds deserve a bit of celebration for the kind of progress you've made over the many, many years. But that celebration has to be exactly for a few nanoseconds, because the road ahead is still very, very long, both in terms of opportunities and in terms of threats. And I want to talk about them as well, the opportunities and threats as we go along, to complete the picture. Now, in terms of mutual funds and the celebratory part, there are various aspects where I think you as a community have done phenomenally well. Just start with the numbers, and these are numbers you are very familiar with, but it's still worth reiterating. As of March 2020, your AUM was about 22 lakh crores. Today, I believe for September, you've come to almost 48 lakh crores, which is a phenomenal growth, right? In terms of number of investors who invest into mutual funds, unique investors, removing all the deduplication, etc., across folios, you had about 2.2 crore investors as of March 2020. Today you have, I'm told, 4 crore investors as per the data available with SEBI, which is again a phenomenal growth over the last 3 years. Now it goes beyond that. I have to say this, even wearing a SEBI hat, I think you guys have been a fantastic ambassador for the securities market ecosystem as a whole. So you should not just take pride in the numbers that I mentioned in terms of AUM and number of investors, etc. But even if you see the otherwise financial inclusion that we have seen, especially into the securities market ecosystem, so you know, for instance, that the number of unique demat accounts that we had as of March 2020 was about 4.2 crores. Today it's about 8.9 crore unique demat accounts. Okay, we have another metric in SEBI, which is within the SEBI universe, if you include all our regulated entities, therefore the conduits to the securities market ecosystem, for the first time in September 2023, the number of unique participants via the SEBI regulated entities entering the securities market ecosystem crossed 10 crores for the first time. It's a phenomenal achievement, and it's been a very, very good growth over the last few years. So take a bow. You've all been part of this journey, and it's an ongoing journey. But I have to underline this, that celebration remains only for a few seconds, because we've got a long, long, long path ahead of us. And this is in both in terms of the opportunities and in terms of the threats or the challenges, right? And often opportunities and challenges go hand in hand. The same factor is both an opportunity and a challenge depending upon how we respond to it. So let's take a look at some of the opportunities and challenges right away. In terms of financial inclusion, while we celebrate 4 crore mutual fund investors, while we celebrate 10 crore investors through the SEBI ecosystem into the securities market ecosystem, here are some other sobering facts. The number of accounts that we have where PAN has been linked to Aadhaar as per CBDT is 51 crores. So if you look at that as the base, as the target audience, 4 crores or 10 crores tells you we still have a long, long way to go in terms of financial inclusion, right? Likewise, if you look at the size of deposits in the country, in the banking system in the country, that's now 200 lakh crores. So when we look at the amount of retail participation through mutual funds, etc., we still have a long way to go. By the way, the numbers are as follows. In March 2020, individual AUM, that is individuals putting money into mutual funds, was about 12 crores. Today, it's crossed 26 lakh crores. 12 lakh crores has become more than 26 lakh crores. Within that, if you look at retail, pure retail, not high net worth individuals, pure retail, where the folio sizes are less than 2 lakh, that number has gone from about 4 lakh crore to 12 lakh crore. Again, a fantastic growth over the last 3 years or so. But nevertheless, compare that 12 lakh crore with 25 lakh crore of savings accounts, with 32 lakh crore of currency in circulation, and it tells you the size of the opportunity that lies ahead of us. Again, another metric which you're very familiar with, the B30, beyond 30 cities that you cover in the mutual fund ecosystem, that used to be about 4 lakh crore of AUM till in March 2020. Today, it's about 8 lakh crores. So we still have a long, long way to go, again, in terms of the sheer size of the opportunity, both in terms of financial inclusion and in terms of expanding the reach. So that's clearly a big, big opportunity. The second area where I think we have a big opportunity, and you have to play a big role there, is investor education. This is a vast area, and it's for all of us together. Every single stakeholder has to take part in this. But think of it logically. If you want financial inclusion to happen, if you want this 10 crore number or 4 crore mutual fund numbers to go into 20 crore, as this program talks about, you need more and more education so that people feel comfortable coming into the securities market ecosystem. Now, one particular aspect of financial market education and literacy that I think is super crucial is working a lot more on explaining the concept of risk. You know, one concept we've got well is the concept of return. So for instance, when you say over the last 10 years, Nifty has given you 12.8% compounded annual growth rate returns, that's something that people understand. People have understood that if you compare equity with gold, with real estate, etc., what are the relative returns from a historical basis. So people understand returns. People are yet, I think, to imbibe risk as a metric. We made a small start in terms of using riskometers, that color-coded. We try to make it as simple as possible. But there are better ways to measure and explain risk. Now, the moment we say risk is equal to annualized standard deviation of log normal returns, we lose 99% of the population. But we do have numbers of volatility to measure risk. What we need to be able to explain is what is a 15% annualized volatility? What does it mean in terms of what the investor feels in her bones? What does a 30% volatility mean? For instance, Apple, a great stock within NASDAQ, which has shown fantastic returns over the last 10 years, if I remember correctly, around 25, 26% annualized returns. Do you know that it has an annualized volatility which actually competes with Bitcoin in terms of actual volatility? So, why is that number and understanding what that number means very important? Because that number actually tells you beyond returns, what is it that you're likely to feel in your bones as you see the value of your portfolio go up and down? You have to correlate it with that. The second corollary which comes out of a risk risk acceptance and risk measurement is the next education, which is that, for instance, if you buy one particular stock, which gives you a 15% annualized return with a 30% annualized volatility, is that the best investment opportunity? And then your efficient market hypothesis will tell you that's not the case. For a 15% annualized expected return, you can construct a portfolio of assets, of investment assets, which give you that return at far lower volatility, at far lower risk. A great example is Nifty itself. Nifty as a whole has a volatility over the last 10 years of about 18% or so. Individual stocks are typically 30-35%, which is why you as mutual funds are doing such a great job. You're actually providing a portfolio risk and therefore reducing the volatility in many ways. This explanation has to go of understanding what is risk, being able to communicate that the way we communicate return, and getting people to therefore appreciate how do you reduce risk. There are other education on the aspect of financial literacy and especially securities market education that needs to be done in the ecosystem. We need this education to go through. I'm going to quote a couple of other papers here, and actually 3 papers. So there's this lovely paper by Barber and Odeon, of 2001, which is very provocatively titled "Boys Will Be Boys," and it goes on. It's a long title. It asks the basic question, who make better investors, men or women? And it goes on to answer that question, no prizes for guessing, that women make far better investors than men. It actually does a research of 35,000 accounts in the broking ecosystem in the US in the 90s, goes account by account. What it finds is that it's not because of gender alone, by the way, it's a catchy title. What it shows is that the more you trade, the more you lose as a retail person, and therefore the less you make. This paper effectively finds that women have less confidence, they are less sure about what they are doing. I'm not saying this, the paper says this. And because they are less sure, they trade less, therefore they lose less. Men, on the other hand, think they know wrongly, therefore they trade more, therefore they lose more, and therefore they make less. The difference between single women and single men annualized in the US in the 90s was 2.5% per annum, as per this paper. It's a peer-reviewed research paper. So there are plenty of other papers like this. The other lovely seminal paper, which many of you wealth managers must be talking about, is this Brinson Hood Biebauer, 1986, which effectively shows that the variation in return across various portfolios can 90% be explained purely by asset allocation. Choice of security, timing of security, etc. accounts for less than 5% of the variation in the returns of a portfolio. If you put all this together, what it tells you, be clear about what your risk appetite is. Construct an asset portfolio which ties up with that risk acceptance and sit on it. Do nothing. And that is your best chance for making what is called the efficient frontier of the highest possible returns for that risk acceptance. This is the kind of education that we need going through to people so that they have to rely less on finfluencers and other charlatans who are giving them get rich quick tomorrow kind of philosophies and getting them to induce them into the market. The reason it irritates SEBI no end is not just because it's wrongdoing. It's because they are playing with the most fundamental attribute of the securities market ecosystem, which is trust. If we lose the trust in the ecosystem of the average investor, we are doomed. Capital formation, which is the core of our mandate, relies on trust being in the ecosystem. So education, perception of risk, acceptance of risk, doing things the right way based on your risk appetite, all this is super important to ensure trust remains in the ecosystem. Nobody gets a negative shock they're not prepared for. Look, we are not a nanny state here. I'm not going to stand here and say markets are overvalued or undervalued. You should buy today, you should not buy tomorrow. SEBI will never do that. Many of you will never do that. That's not really our job. But our job is to ensure that there is adequate education, there is adequate disclosure, which is one of the reasons why SEBI came out with that research paper earlier this year in January, where we showed that 89% of retail participants in futures and options actually end up losing money. Now, that doesn't mean we are telling you to stop trading. It's your hard-earned money. You know better than us what you need to do with that money, right? But here is what we are doing. We now are ensuring that every time somebody logs into a broker terminal, there is that irritating pop-up that comes up saying 9 out of 10 traders lose money. Click it, be accepting of that risk, and do what you want with your money. Now, why am I telling you all this? This is the kind of messages I think as a community of good people. By the way, my chairperson referred to you as the bada beta of SEBI, as the favored child of SEBI, because you are well on your way to building that trust as an ecosystem. We as an ecosystem have to ensure this disclosures, this education goes through so that nobody is taken for a ride in this entire ecosystem. I'm going to mention one thing which is this is a personal thought, this is not a SEBI thought. Please don't blame Amarjeet for this. While we have no business opining on whether a market is overvalued, undervalued, whether there is a bubble or not, whether there is a big opportunity to buy or not, we will never say that. We are not experts. In fact, we will probably be wrong even if we started to think along those lines. So we won't even try. But there are a few basic risk questions that I think we need to debate as a community, starting from you. So here is one statistic which stuck out to me. In the small cap segment, for instance, in March 2020, the holding of mutual funds was about 8.6% of the total ex-promoter holding. Okay, I'll repeat that, 8.6% of the non-promoter holding of small cap funds was in the hands of mutual funds. Today, that number is 19%. Okay? Now, why am I saying this? I am not imputing anything whatsoever. All I'm saying is a simple risk metric for all of us is to ensure, especially since these are open-ended funds, that the liquidity in the underlying market can sustain the amount of holdings that you have as a community in that particular segment or stock or script or asset class. One of the issues that we had in the debt market some years ago is when the debt holdings of mutual funds, open-ended mutual funds, became far higher than the underlying liquidity in the secondary markets. And therefore, when you had an event of actual withdrawals coming through, there was a problem. Let me reiterate, there is no problem today. Things are absolutely fine, which is why it's the right time to talk about these things. There is ample market liquidity. You guys are doing a good job of managing risks. But at the time when things are looking good is when we should think about these risks and proactively see what is it that we need to do to manage these risks. At the very least, if we have to disclose and make sure that the investors are aware of these particular kind of risks, I think that should be done as well. Now, I'm going to leave with a couple of other points for pondering in terms of challenges. One area where we rely on the mutual fund community a lot is in the area of distribution. So when you have mutual fund distributors and we have ARN number holders, it's almost 1.5 lakh ARN holders in the ecosystem today. That's managed by AMFI, that's managed by the mutual fund ecosystem, right? And the ARNs, the distributors, are part of this ecosystem which I praised earlier. You guys have done a fantastic job collectively. There's no questions asked. All the numbers that we saw, all the financial inclusion that we saw belongs to this entire community. But here is one thing we should be aware of. We talked about asset allocation, the need to diversify, right? Distributors, by definition, get paid by the commissions they earn on the products that they sell. By definition, the incentive system is not necessarily geared towards ensuring that the best possible asset allocation from the client's perspective is maintained, right? Now, we have checks and balances for that. We have a code of conduct which requires fiduciary responsibilities to be maintained, etc. Implementing that has to be maintained at all points of time. So here is my request to you as an ecosystem. please ensure that this ecosystem, which is doing well, a great job of distribution, continues to have robust checks and balances, which ensure that there are no perverse incentives building up in the ecosystem, which sell products basis the commissions being earned rather than what is appropriate and suitable for the customer, especially the retail customer. I personally get very nervous when I see commissions being handed out to relationship managers, etc., based on how much volume of a particular product has been sold. The only metric in my view, and this is a personal view, as a regulator we should not have a view, as in my personal view, the only metric that matters is taking care of the interest of the client, the best interest of the client. And that has to be somehow actually be implemented. Last point, I already have 50% of the audience sleeping, so let me quickly end here with the last point, which is you guys are the smartest people I know in the securities market ecosystem, okay? And the amount of depth of knowledge that you have, because you speak to individual investors, you speak to issuers, you speak to people who are there in the market, you speak to brokers, the other regulated entities, you know a lot of what's happening in the ecosystem. Here's my request to you. If you see something, say something. And I go back to this point about needing to retain trust in the ecosystem. You're not doing chugli on anybody. You're not snitching on anybody. What you're doing is, if you see egregious practices which potentially have the potential of endangering the trust in the ecosystem, it is your duty to come out and speak. SEBI, unfortunately, is often like the old Hindi movie, Policewala, who comes in the last scene after the climax is over, with the gun and firing in the air. You guys are the heroes who are there on the ground, who know what's happening. I know you're doing this in parts, but my collective request to all of you is, if you see something, say something. So I'm going to summarize here. Look, as a regulator, we are in the business of facilitating sustained and sustainable capital formation. We are not just a regulator. We want to see this ecosystem grow. Kudos to the mutual fund ecosystem. You've done a fantastic job. The numbers speak for themselves. Financial inclusion, financial spread, financial literacy. One thing I forgot to mention, financial stability. In FY22 and FY23, we had 1.8 lakh crores of FII outflows going out of the country. And especially in the period between October 21 to July 22, when you had tightening of the US, bond markets, and you had the Ukraine war, etc., you had, I think, about $30 billion of FII outflows at one point of time. The inflows coming into equity markets in mutual funds more than compensated for that through this entire period. For the first time, we had such gigantic outflows of FPI, investments, and we didn't even notice compared to the rest of the markets. Now, I'm not saying that means we don't need foreign savings. We need foreign savings, make no mistake. All I'm saying is, at a time when the global markets are uncertain, when you have, dollar index going up, when you have bond yields elevated, when you have commodity prices very iffy, it's great to know we have resilience within our financial savings ecosystem, hopefully that can support our capital formation process. So you've done a great job so far, but do not rest on your laurels for more than a second. You're only as good as your last quarter. The slate is reset. You have huge opportunities and you have huge threats in front of you and challenges in front of you. I think we have a lovely opportunity for our country to achieve our enormous economic potential. You will play a crucial part in the capital formation which aids in that particular process. It's for us to ensure that we nurture that growth, and I'm sure a few years later when we come back again, we will come back and celebrate, but a lot of hard work to be done in the meantime. Once again, thank you so much for Moneycontrol for giving me this opportunity.
Sir, thank you very much for your very insightful comments. You spoke like a true professor. And thank you for reassessing, the three key elements about financial literacy. One, you spoke about education, you spoke about risk, and you spoke about asset allocation. So thank you, sir, for your speech. And Mr. Ananth Narayan has agreed to take a few questions, couple of questions from the audience. It's a very rare opportunity that you get to interact with the regulator. So we can take 2 or 3 questions. Yes, sir. Can we have the mic over there?
Yeah, sir. Myself is Chinmay. Sir, my direct question to you is, I've been here in this industry as an MFD for almost 30 years now. I have liked this industry like anything. Sir, if every time we have to change and the things around don't change, where do I take inspiration from?
So, could you expand that question a little bit?
Sir, every time if I change and things around do not change, then when do I take my inspiration from?
Can you assume I don't understand your question? Can you expand on that and explain?
Sometimes you want people to change and they do not change. So where do I go? And I believe, and I certainly believe that the point that you made, that you have to speak. You can't just sit there.
Oh, okay.
So, that's okay. But apart from there, we have the sanctity of not complaining and, going on that way. But why don't we improve ourselves 15% every year and then get on to a place where you don't need change to happen? That doesn't happen. Things do continue and then it's like we have to speak. And once you speak, it's always the black mark on the white shirt.
Okay. So, first of all, I would start off by saying you as a community have changed a lot over the last few years. So when you say that things are remaining the same, at least as an outsider looking in, and I've been an investor for many years, if I see the amount of new things that you've brought on board, I think it's been quite a lot. For instance, this entire philosophy of SIP, which has grown so much, which has gathered so much steam. I believe now there are 7 crore folios in SIP, 16,000 crores almost every month, 2,000 rupee sachet, total sachetization of financial savings. That's a lovely, innovation that you've come out with over the years. Likewise, I mentioned, I think there are 1.5 lakh ARNs right now, including yourself, who are again doing a great job, all in all, of distribution. In terms of new products, I see Radhika here. So, for instance, the Bharat Bond ETF, which was brought out a few years ago, I think that's been a great success story as well. Now, here is the lovely part. We are a growing nation. Whether we like it or not, we are very different from what we were 10 years ago. And whether we like it or not, we will be very different from what we are today, 10 years hence. Now, I think it's an extremely exciting time to be in this community. So in terms of, for instance, new products that I can think of or new opportunities I can think of. For instance, in InvITs and REITs, we barely have, 5,000 crores in mutual funds currently, less than 2% of the outstanding of InvITs and REITs.
True.
I think as a class, things like InvITs and REITs, municipal bonds, etc., their time will come. And when their time comes, you as a community will have to step up to that plate and make it grow. Another example, debt markets. 2018 May, before ILFS, etc. happened, the mutual fund community had about 6 lakh crores worth of dated corporate bonds on their books. Today, that number is lower than 6 lakh crores. Now, we have ways to go in terms of actually growing that debt pile as well. Likewise, when you talk about ESG as a asset class that require, we are part of the early warning group of the FSDC subcommittee, where we try and measure what is the actual financing required for ESG purposes and what is the actual financing going through all our regulatory bodies. There's a huge gap. So whether it's infrastructure financing, whether it's ESG financing, there's a huge ask here. Now, that's on the demand side. On the liability side, as I said, if you have 4 crore mutual fund unique investors today, and the actual PAN Aadhaar linked numbers are 51 crores. If you have, 8 crores or 12 crores worth of retail assets on mutual funds, whereas savings accounts alone are 25 lakh crores. There's plenty of space to grow. This is a growing space, make no mistake. There of course will be challenges. And because we are growing at this rapid, frenetic pace, we can't expect a smooth transition either in terms of policy or in terms of actual happenings on the ground. A 17-year-old showing growth spurts and hormonal changes cannot show the sagacity of a 60-year-old when it comes to growing the market, right? We will both come together. So my only request is, and by the way, I think we're already getting there, especially with AMFI and the mutual fund participants, etc. The need to preserve the ecosystem, the trust in the ecosystem, is too important a role to be left to the regulator alone. And I think we all agree with that. It's far too important. And if 1,000 people in SEBI had to take care of this trust in the entire ecosystem, we are doomed. Every single stakeholder, including everybody in this room, has the responsibility to ensure that that trust is preserved. Which means if you see something wrong, please say something. Right? How you do it, how we develop the ecosystem for doing it, I think we have very good channels of communication between the industry and SEBI right now. And it has developed over the last few years. And work will continue on that front. So have heart. You're in a lovely spot. I think a lot of people in other countries would give their right arm to be in your place in a market like ours. This is our opportunity to shine. Change is going to come. It's going to be painful, but I think the fruits are going to be fantastic.
Okay, one last question, and very quickly.
Hello. Yes, sir.
Hello.
Yeah, my name is Amit Naik. I have a slightly different questions, which some of my colleagues would not like to ask you.
We're used to that. Go ahead.
Yeah. See, in 1995, there was a dematerialization of the shares, and industry got revived and consolidated, and this online trading platform started. So I have a similar question with respect to mutual fund units. Do you have any, do you have any in your mind, like in SEBI's mind, to make the mutual fund units dematerialization? Because if you do it mandatorily, the mutual fund industry would consolidate, and then it would be really great, because the way forward is the digitalization of the mutual fund industry. So can SEBI make it mandatory of mutual fund units?
So here is my simple twofold answer. First, I'm going to pass on this question to Amarjeet Singh because he's the right person to actually tackle this question. But I can tell you straight away as SEBI. One is, look, to the extent that you have RTAs, that the fact that your portfolios can already come up in the NSDL common account statement by virtue of those RTAs, I think a lot of the benefits of dematerialization are already there in the units the way they are. Having said that, if at all there are ways to improve, we are very open to suggestions. As a regulator, we are extremely consultative. We have the Mutual Fund Advisory Committee. We have public consultation papers. We take every single query, response that comes to our public consultation, we take on record. By the way, we are subject to the 3 Cs as well, CBI, CAG, CVC, which means every response that comes has to be tabulated and taken care of and acted upon. We are consultative. If you think there is a merit in going in this particular path, please come through the right channels. Please make a representation yourself. Very, very happy to consider. We are always open for ideas.
Okay, thank you.
We can take a couple.
We can take one more question.
Yeah.
Actually, this gentleman was in queue.
So he can also come.
Okay.
Please, you can.
My name is Sandesh. So mutual fund industry increased by 33%. So what is contribution of financial market?
Hello. Sir, you have taken.
What is contribution of financial markets?
Yeah.
Are you saying that there's no contribution of financial markets, or are you asking what is the contribution of?
No, government, Indian government, what is contribution?
Oh, okay. What is the? Okay. So look, again, this is we can have a separate chat over a cup of coffee on this. But let me put it this way: for an ecosystem to grow the way it has, every stakeholder has to play a part, and I mean every stakeholder: mutual funds, distributors, AMFI, brokers, exchanges, SEBI, investors, media, all of us, right? We will grow together or sink together. That's the reality. I think everybody is playing a part. In many of the new ventures that you're seeing, including in terms of InvITs and REITs, including in terms of getting new products off the anvil, things like this, ETFs, etc., coming off the anvil. There's been a lot of participation of many stakeholders, and I think that will continue. As far as capital formation as the ultimate goal is concerned, we are absolutely all on the same page. I don't see any difference of opinion on that. If there are suggestions you have for specifically SEBI, please do send it to me. No problem at all.
So last question.
Sure.
This is Ashok Bhatt speaking. As per the levels of risk, FD has the lowest risk, bonds, and then mutual funds. People earlier used to invest in equities and lose heavily. And now we have got mutual funds which take care of some of the risk by their expertise. But now we have seen that more and more people are investing in F&O, and nearly 90% are losing money in that. There are many individuals who want to take higher risks and get a higher return. Why not have SEBI approve some mutual fund schemes which invests in these F&O. People are knowing what are the risks involved and what are the returns they can expect.
So I'll break it up into two parts. As I said in the beginning, SEBI has no role to play. We are not an nanny state to advise any individual on where she should invest her hard-earned money. It is entirely her choice where she wants to put it, whether in F&O, whether in cash markets, whether in fixed deposit. We are no one to tell anybody anything in terms of actual advice. We want disclosures to be made so that people are doing so with eyes open and full awareness of what they are doing, which is why I talked about investor education, and which is why, to your point about F&O, I made the point that 90% of retail investors actually end up losing money in F&O. This is a point that people should be aware of. After that, it's their requirement. The broader point I wanted to make was, even if an individual is accepting of higher risk, supposing my risk acceptance is 50% volatility, which by the way is very high risk, the simple point is there are portfolios that exist outside of one single stock, which can give you a higher return than one single stock for that 50% risk. That's the whole point about that asset allocation and matching risk and return requirements to get the best possible portfolio. On mutual fund schemes per se, there is a process. Mutual funds have every right, if they see adequate demand for certain kinds of products, there's a way in which they do a dialogue with SEBI, with other stakeholders to see if such things can be launched. If there is adequate demand for such, I don't have to do anything. We have a free market here of people who are acting reasonably freely. If they see a requirement for a particular kind of fund, I'm sure the demand will come up automatically. There'll probably be a race amongst them as to who will come first with an adequate product. Yes, we will want to make sure that the risk and therefore what they're getting into of that particular product should be adequately emphasized. We have a riskometer right now which gives you a color-coded picture. If you do go into an F&O based product, we'll probably require a deeper green, a deeper shade of red somewhere in the riskometer, but we'll find out a way to actually portray that risk.
That means SEBI doesn't have any problem in mutual fund promoting such schemes.
SEBI has a process of having a dialogue to figure out what is the requirement, etc., etc. The industry leads the path on what they want. As I said, we are a disclosure-based regime. As long as the risks are adequately disclosed, we are not a nanny state to say, do this and don't do that. We want true to label, we want no misleading, we want no mis-selling, we want no unsuitable products being sold. Within these parameters and with disclosure, we have no problems with any kind of products. The rest, the industry knows how to take care of itself. They're very smart people sitting out here. Okay, thank you very much.
Thank you very much. Thank you, sir.